Silver just punched through $91 per ounce this morning. That's an all-time high. You'd think that's celebration time. Right. But here's what they're not telling you. The CME Group just rolled out a brand new margin system, specifically designed to choke this rally before it gets out of control. And if you understand what happened 45 years ago, you'll recognize this playbook instantly. I'm talking about the Hunt brothers. You've probably heard the story. Two Texas billionaires who tried to corner the silver market back in 1980. Silver hit $50 an ounce, and then regulators changed the rules overnight. They called it Silver Rule 7. Suddenly you could only liquidate positions, not open new ones. The Hunt brothers got wiped out, lost everything, went bankrupt. Everyone remembers that part. What most people forget is the people who owned physical silver, the ones holding actual metal in their hands, they came through just fine. The leverage traders, the paper players, they got destroyed. Now fast forward to January 13th, 2026. That's 2 days ago. The CME announced something they're calling a fundamental shift in how they calculate margin requirements for precious metals. Used to be a fixed dollar amount. You wanted to trade a silver contract, you put up a set amount of collateral. Simple, predictable, but now they've switched to a percentage system. 9% of the contract value for silver. Sounds reasonable until you think it through. When silver was at $50, 9% of a contract meant one thing. But at $91, that 9% just got a whole lot bigger. And here's the real kicker. As silver keeps climbing, that margin requirement climbs right alongside it automatically. There's no cap. There's no ceiling. It's an escalating tax on anyone trying to profit from this rally. The higher silver goes, the more capital you need just to stay in the game. And if you're trading on margin, which most speculators are, you're going to hit a wall real fast. You know what this reminds me of? Exactly what they did last month. December 26th, the CME raised initial margins from $20,000 to $22,000. Silver kept climbing anyway. So December 30th, they hit it again. This time, a 30% increase. Margins jumped to $32,500. And you know what happened? Silver crashed. Dropped from $84 down to around $70 in a matter of days. A 17% wipeout. Traders without enough capital got liquidated. Forced selling cascaded. The rally got cut off at the knees. But here's the thing they didn't expect. Silver came roaring back. Within 2 weeks, it blew past the old high and set a new record. Physical demand didn't stop. Industrial buyers still needed the metal. Investment demand kept accelerating. China's export restrictions kicked in January 1st, just like they said they would. Only 44 approved companies can export silver now for the next 2 years. That's not a rumor. That's official policy from the Chinese government. And China controls a massive chunk of global supply, so the CME's got a problem. They can raise margins all they want on paper contracts, but they can't create physical silver out of thin air. And that's what's really happening here. Let me show you the numbers. On January 7th, holders of January 2026 silver contracts stood for delivery of 8.1 million ounces of actual metal. That's not traders rolling positions forward. That's people saying we want the real thing. Ship it to us. That kind of delivery demand doesn't happen in normal markets. It happens when people stop trusting paper promises. Now look at what else is going on. Silver's been in backwardation. That's when the spot price, the price for immediate delivery, is higher than the futures price in a normal market. Futures trade at a premium because you're paying for storage and time. But when backwardation shows up, it means physical metal is so tight that people are paying more to get it right now than they're willing to pay for delivery. Months down the road, that's desperation. That's a shortage signal. And it's been persistent. Then you've got lease rates. Back in October, silver lease rates hit 39%. Think about what that means. If you want to borrow physical silver, you're paying 39% annual interest. Nobody pays that kind of rate unless they absolutely have to have the metal and can't find it anywhere else. Investment-grade corporate bonds trade around 5%. High-risk junk bonds might hit 12%. 39% is panic mode. It's a flashing red light saying there's not enough metal to go around. And here's where it gets really interesting. Asia's paying 80% premiums over spot price in some markets. 80%. You're looking at silver quoted at $90 in New York, and dealers in Asia are charging over $160 for the same ounce of metal. Why? Because they can't get it. Supply lines are broken. Dealer inventories have been wiped out. There's a report from early January saying many precious metals dealers' silver inventories have been decimated. Those are the exact words used. Decimated. Not low, not tight, decimated. So let me connect the dots here. You've got unprecedented physical demand. You've got supply restrictions from China. You've got delivery pressure on the COMEX. You've got backwardation and skyrocketing lease rates. And in response to all of this, the CME changes the entire margin structure to make it harder and harder to stay long as the price rises. Does that sound like a free market to you? Or does it sound like someone trying to engineer a ceiling? Let's go back to 1980 for a minute because the pattern is unmistakable. The Hunt brothers accumulated a massive position in silver. They were taking physical delivery. Prices went parabolic. And on January 7th, 1980, exactly 46 years ago almost to the day, the COMEX introduced Silver Rule 7. You could sell, you could liquidate, but you couldn't buy. That's not a market. That's a controlled demolition. And the Hunts, who were leveraged up with borrowed money, couldn't meet the margin calls. They got forced out. Bankruptcy done. But here's what they don't teach you in the history books. The people who owned physical silver, who weren't trading on leverage, who just had metal stored away somewhere safe, they came out fine because physical silver didn't disappear. The metal was still valuable. The price eventually recovered. But the paper players, the ones playing with futures contracts and borrowed money, they got annihilated when the rules changed mid-game. Now think about the timing of what's happening right now. December 26th, first margin hike. December 30th, second margin hike. 30% increase. January 1st, China's export restrictions take effect. January 13th, the CME switches to a percentage-based system that automatically escalates margin requirements as price rises. This isn't spread out over months like 1980. This is all happening in a span of 2.5 weeks. The pressure is compressed, the timeline is accelerated, and the tools they're using are more sophisticated. Back then they had to pass a specific rule. Now they've built an automatic break into the system itself. And there's another massive difference. In 1980, the silver shortage was artificial. It was created by the Hunts buying up supply. But today the deficit is structural. Industrial demand is exploding. Solar panels use silver. Electric vehicles use silver. The entire green energy transition requires silver. There's a 5-year cumulative deficit happening right now. The world is consuming more silver than it's producing. That's not manipulation. That's mathematics. And there's no easy fix. You can't just mine more silver overnight. These are decade-long projects. So when the CME raises margins, they're not just targeting speculators. They're making it harder for anyone to hedge against the legitimate supply crisis. Industrial users need to lock in future prices. But if margin requirements keep climbing, smaller companies get priced out. They can't afford to put up the collateral. So they're forced to take spot market risk and hope supply holds up. That's not risk management. That's rolling the dice. And let's talk about what this means for the paper silver market specifically. You got ETFs like SLV. Millions of people own shares. They think they own silver, but what they really own is a claim on silver that somebody else is holding. And here's the uncomfortable question. What happens if everyone tries to redeem those claims at the same time? What happens if the trust doesn't have enough physical metal to cover all those shares? You've seen ETF flow data turn positive after years of outflows. People are piling into these products thinking they're getting exposure to silver. But exposure isn't ownership. Exposure is a promise, and promises can be broken. Look at what happened during the March 2020 panic. Spreads between physical silver and paper silver blew out to unprecedented levels. You had futures contracts trading at one price and physical metal trading $8, $10, $12 higher. Why? Because you couldn't get delivery. There was a force majeure declaration in London, the biggest silver trading hub in the world, and they basically said, we can't guarantee physical settlement. What do you think that told people about the reliability of paper silver? It told them when the chips are down, paper is just paper. Now we're entering 2026 with even tighter physical markets, even more industrial demand, even stricter export controls. And the exchange that's supposed to provide price discovery is systematically making it harder for the price to reflect physical reality. That's not a conspiracy theory. That's what margin hikes do. They reduce speculative demand. They cool off rallies. That's the stated purpose. The CME will tell you they're managing risk and ensuring orderly markets. And maybe that's true, but whose risk are they managing? The shorts who sold metal they don't have? Or the longs who see a genuine supply deficit and want to protect themselves? Because here's what nobody wants to say out loud. If silver truly reflected the physical shortage, if the price was allowed to move freely based on actual supply and demand, it would be significantly higher than $91. Maybe triple digits, maybe beyond. But a price explosion like that would devastate anyone who's short. And there are major institutions that have been short silver for years, decades even. We're talking about commercial banks that use short positions to hedge their mining loans. We're talking about market makers who've built their entire business model around volatility, staying within certain ranges. So what do you do when the market starts moving against you? When physical demand is overwhelming and price wants to explode, you change the rules. You raise margins. You make it too expensive for the other side to keep playing. You don't have to outright ban buying like they did in 1980. You just make it economically impossible. Same result, different method, more subtle, harder to call out, but just as effective at stopping a rally in its tracks. And this is why the physical versus paper distinction matters so much. When you own physical silver, a coin in your hand, a bar in a safe, nobody can change the margin requirements on you. There's no counterparty. There's no exchange. There's no administrator who can wake up one morning and decide you need to post more collateral or get liquidated. You own the metal. Period. End of story. That's the lesson from 1980. That's the lesson from every market crisis. The Hunt brothers lost their fortunes because they were leveraged. Because they were trading contracts, not holding metal. The people who quietly accumulated physical silver and just held it, they did fine. The metal didn't vanish. It didn't become worthless. It was still silver. And over time it retained its value. But the paper traders, the ones who thought they were clever by using maximum leverage, they got crushed when the rules changed. So let's bring this back to right now. This morning, January 14th, 2026, silver at $91 and change. CME's new percentage-based margin system in effect. What happens next? Well, one of two things. Either silver breaks through and keeps climbing, in which case margin requirements are going to keep escalating automatically, squeezing out more and more traders until the rally exhausts itself, or silver rolls over, crashes again, like it did in late December, and everyone says, see, the bubble popped, the mania's over. Move along. But neither of those outcomes changes the underlying reality. Physical silver is in short supply. Industrial demand is growing. China's tightening exports, dealer inventories are depleted. Those facts don't change because a futures contract gets liquidated. Those facts don't change because margin requirements went up. The paper market can do whatever it wants. Price can swing wildly. Speculators can get wiped out. But at the end of the day, someone needs to deliver actual metal. And there's not enough of it. That's the disconnect everyone's ignoring. The paper market is a voting machine. It reflects sentiment, momentum, short-term positioning. But the physical market is a weighing machine. It reflects how much metal actually exists versus how much metal people actually need. And those two things are heading in opposite directions. Paper can trade wherever. But physics doesn't care. You can't print silver. You can't create it with monetary policy. You either have the metal or you don't. So if you're someone who's been watching this rally and thinking about exposure to silver, you need to ask yourself a fundamental question. Do you want to own a promise? Or do you want to own the actual thing? Because a promise is only as good as the entity making it. And we've seen what happens when physical markets seize up. We saw it in 2020. We're seeing signs of it again now. Promises get delayed. Settlements happen in cash instead of metal. Force majeure clauses get triggered. And the people holding paper are left standing there wondering where their silver went. Physical ownership means coins. It means bars from recognized mints. American Silver Eagles. Canadian Maples. Bars from refineries that meet good delivery standards. It means metal you can hold, metal you can store, metal that doesn't depend on any institution's solvency or any exchange's willingness to honor delivery. It means you've removed yourself from the paper games entirely. Nobody can margin call you. Nobody can change the terms. Nobody can liquidate your position because some risk management algorithm decided the market's moving too fast. And I know what some of you are thinking. Physical silver has premiums. Dealers charge more than spot price. You're right. But think about what that premium represents. It's the difference between a promise and reality. It's the cost of actually securing metal in a market where metal is getting harder to find. Yeah, you might pay 8%, 10%, even 15% over spot depending on what you're buying and where you're buying it. But if spot itself is artificially suppressed because of margin hikes and paper market manipulation, then you're paying a premium over an artificially low price to get the real thing. Is that really expensive? Or is that actually a bargain? Look at what's happening in Asia where premiums are hitting 80% in some markets. That's not a premium anymore. That's a completely different price level. That's the physical market saying we don't care what your exchange says. This is what actual metal costs. And as Western markets tighten up, as dealer inventories here get depleted the way they have in Asia, those premiums are going to rise. The gap between paper price and physical availability is going to widen. And the people who waited, who thought they'd buy physical later, when things calm down, they're going to find out there's nothing available at anywhere near the spot price they were watching on their screens. That's the window that's closing, not the opportunity to make money trading silver futures. That's a speculation. That's a gamble against the exchange's willingness to let you win. The window that's closing is the ability to acquire physical metal at a reasonable cost over spot. Every time the CME raises margins, every time speculators get flushed out, every time the paper price crashes, that's actually an opportunity to buy physical, because the underlying supply deficit doesn't go away. The industrial demand doesn't disappear. The Chinese export restrictions don't get lifted. The fundamentals remain, but physical availability keeps declining. And here's the final thing I want you to think about. In 1980, the COMEX had to pass a specific rule to stop the Hunt brothers. It was visible. It was obvious. It was controversial. People could point to January 7th and say that. So it was when they changed the rules. But in 2026, they built the rule changes into the system itself. Percentage-based margins mean automatic escalation. They don't have to call a meeting. They don't have to announce emergency measures. The higher silver goes, the harder it gets to trade. Automatically. It's genius from a control standpoint. It's a throttle built into the machinery, and most people won't even notice because it looks like standard risk management. But you're noticing. You're seeing it. You're connecting the dots between what happened 46 years ago and what's happening right now. You're understanding that the paper market is a controlled system, and physical ownership is the only way to step outside that system. You're recognizing that when prices spike and then get hammered back down, that's not natural market action. That's engineered price suppression through margin manipulation. And you're realizing that the time to act is before the gap between paper and physical becomes so wide that regular people can't afford to cross it. So here's what I'd encourage you to do. Don't take my word for any of this. Go look up the CME margin announcements yourself. Check the dates. See the percentage changes. Read about Silver Rule 7 and what happened to the Hunt brothers. Look at current delivery data on the COMEX. Check lease rates and backwardation. Verify China's export licensing policy that started January 1st. Do your own research. Form your own conclusions. But do it quickly. Because markets don't wait. Supply doesn't wait. And the gap between paper promises and physical reality is widening right now in real time. If this is clicking for you, if you're understanding why physical metal matters in a way paper claims don't, hit that subscribe button. This channel is about cutting through the noise and showing you what's really happening in precious metals markets. The mainstream financial press isn't going to connect these dots for you. They're going to tell you silver's volatile. They're going to tell you it's risky. They're going to tell you to stay diversified in traditional assets. But they're not going to explain why the CME is systematically making it harder to profit from a legitimate supply crisis. They're not going to tell you that the paper market is a control system. And they're certainly not going to suggest you take physical delivery and remove yourself from that system entirely. Drop a comment below and tell me what you think. Are you seeing the same patterns I'm seeing? Have you been trying to buy physical silver recently? What are dealers telling you about availability? What premiums are you seeing in your area? Let's get a conversation going because this community is built on real people sharing real experiences. And if you've already secured physical metal, if you've already understood this dynamic and taken action, share your perspective with others who are still figuring it out. That's how we learn. That's how we protect ourselves. That's how we navigate a market that's increasingly rigged against anyone trying to preserve wealth through hard assets. And make sure you've got that notification bell turned on because this story is far from over. Silver's at 91 today. Could be higher tomorrow, could be lower, but the fundamentals aren't changing. The supply deficit is real. The export restrictions are real. The delivery demand is real, and the margin manipulation is real. How that plays out over the coming weeks and months is going to be fascinating to watch. But it's also going to be critical for anyone who wants to protect themselves from currency debasement and financial system instability. Because at the end of the day, silver is money. It's been money for thousands of years. And no matter what games they play with paper markets, they can't change that fundamental reality. So stay informed, stay focused, and most importantly, stay positioned in physical assets that can't be manipulated by rule changes or margin hikes, because when the dust settles, when the paper market gains are over, the people holding real metal are going to be the ones who made it through intact, just like after 1980. Just like after every crisis. Physical survives, paper doesn't. That's not opinion. That's history, and it's about to repeat itself. Thanks for watching, and I'll see you in the next one.